And you rightly point out, we are held hostage by macroeconomic events, the markets are. It's not always that way, but it certainly is that way right now. You also point out that it's rare to have the Fed talking about being tight, acting on being tight, raising rates after you see equity markets down 20% or so, that never happens. Now, I don't know whether you're proposing some type of Fed put, because stock market prices aren't one of the dual mandates. There's not three mandates, but you point out that it's just rare to see them be so strident when you've got at least a harbinger of what could be a big slowdown in the economy. That's what the market indicates, isn't it?
For sure. And, they raised rates both in June and September with the market down about 20%. It's not like when the government's giving checks and depositing it straight into people's accounts. Fed policy works through a transmission mechanism called the financial system. So I think Brainerd is correct on seeing the lag effects of what they've accomplished already. Still, even if I think the CPI number comes in below expectations, I really do believe they're kind of data independent, not data dependent right now. And I think they're going to plow ahead with their rate hikes regardless. But not heeding what the words of FedEx or the CEO of the largest bank in the United States, or one of the largest in the world, JP Morgan, could result obviously in a mistake.
And that is, the bright side is that you think that the absolute level of a lot of stocks are in a very good place to be bought if you have a 5-year time horizon. You could find,
for sure.
You could find things for people to buy. I was, in your notes, I was not amused, I was kind of bemused that you said the biggest risk to the market right now, and there's what may be a deranged madman with his finger on a button, but you think the biggest risk right now is a central bank, is a Fed mistake. So that's really saying something. If the Fed, if nuclear Armageddon isn't quite as bad as what the Fed could orchestrate.
Well, I mean, obviously nuclear Armageddon is right. An issue, Joe. I wouldn't be dismissive of that at all.
The world can only end once, and if I don't know how you manage a portfolio if you actually think that's a possibility. No, I understand, right. But just making a point that the Fed has immense power to do good or bad.
I think that we've repeatedly seen mistakes of going too far, repeatedly from the Federal Reserve, and so that's more of what I'm referring to than nuclear war, obviously. And central bank issues. We've had a tremendous amount of intervention, whether fiscal or monetary, since COVID, and there are issues. I look at shopping mall REITs or office REITs, which are near pandemic lows in terms of prices. There's a lot of stuff going on that really actually hasn't recovered necessarily, and so. They're going to where they are. This time last year, the great thing about having the internet is you can pull up every speech given about the transitory nature of inflation and the risks of overreacting to it. And here we are 180 degrees from where we were this time last year. And so, data dependency is important as we're flying sort of a blind here, and as they are as well. And there's a lag effect of what they do, and the transmission mechanism for them is clearly through financial markets. It's the worst bond sell-off we've seen in over 45 years. It's the worst 60-40 portfolio we've seen since 1937. So there is an impact to all of this with some lag effect, and they might not care, or this might give them, some sort of, there might be an ideological reason why they want to have real rates positive for the first time. The one thing I would say about investors, though, for certainly in the equity market over the next 5 years, I think especially where growth stocks are on the relative lows, that they provide a big opportunity. But there is something different this time that we didn't have last time, certainly not since '08, which is that cash has a yield, and by the time they're done, that yield will be over 4%. So I think that there's a lot of investors that have come into the equity markets, fleeing the bond market because there even the checking accounts or savings accounts because there was no yield. For a lot of those people who have bid up utilities or bid up staple stocks to 25, 30 multiples because there's a 1.5% dividend yield, that's going to be probably a secular decline. Whereas those people move back to cash. I mean, it's an attractive yield with zero beta. So, I think the equity market can go back when it's all said and done to rewarding return on equity versus return of equity. And that is a little bit different when you think about asset allocation.